Welcome back. Time for the word on Wall Street. Top investors watching your money. Joining me right now is Bulltech Capital Chief Market Strategist Catherine Rooney-Vera and Michael Lee, Strategy Founder Michael Lee. Great to see you guys this morning. Thanks so much for being here. Catherine, kicking things off with you with Goldman Sachs. Meanwhile, here we are looking at a big week for earnings. Mike, futures are trading higher on the UK news as well as on pretty important earnings that have been out. Bank of America just reported a double beat on both earnings per share and on revenue. We've got Goldman Sachs tomorrow, Netflix as well. What kind of a third quarter earnings season are you expecting? And importantly, are you expecting to hear dire predictions about 2023 when we get the guidance?
Yeah, so I can't imagine guidance being that strong. I think this will be a relatively okay earnings quarter in what you just see with Bank of America. Their net earnings are down year over year, almost $750 million. They made more in this quarter last year than they did today, yet the stock is up because of lowered expectations. So this is coming back to our classical earnings quarters where analyst estimates have come down, and then you get slight beats by these companies, and it's looked at some sort of success. I don't know that the guidance will be as dire as it will most likely end up. I think earnings estimates are too high going into the rest of this year, as well as into next year. You're seeing global PMIs, 2/3 of them are contracting, which historically has not been a good omen for earnings. And then here in the U.S. with the ISM, you have troubling data from the new orders to inventory ratio, which has typically preceded earnings declining dramatically as well as stock prices declining dramatically. So this banking sector, it's interesting to see these stocks bounce off these lows. What I think is the markdowns and the loan loss provisions are not quite high enough. You have $2 trillion being posted nightly at the Fed window. That means there's $2 trillion worth of excess securities inventory that can't find a home, which, you know, in the 2008-2009 crisis meant that a lot of these securities were being marked improperly and that they are worth less than they're being held in the books. So I think there's some loan losses in addition to securities losses that are kind of being papered over right here and now. And so as the Fed lets $90 billion worth of securities run off their balance sheet, do you think these kind of log jams in the capital markets are going to get better or worse? I tend to believe they're going to get worse. I don't know that these banks are going to fall off a cliff, but I'd be using a day like today to take to lighten up on those positions. I had a small position in financials, which I got rid of last week.
Well, Catherine, all the banks are up this morning because we did have